unfortunately, markets leave a lot more to be desired at this stage. We think you need to stay pretty defensively positioned. We are still in the phase where we need to absorb this deterioration in fundamentals and ongoing tightness of financial conditions. That's a recipe for you to stay pretty cautious. Where we would focus is actually on risk-free bonds, US treasuries in particular.
There's nothing risk-free out there. The treasuries, along with the rest of the bond market, lost trillions of dollars last year as well. Yield picking up, albeit off its high, but still ending the year, 3.81. Thank you, team. 3.81 on the US 10-year paper. Wasn't risk-free owning treasuries last year, Hani?
Agreed. And that's why you have to have a good framework to understand what kind of regime we're in and where we are in the cycle, particularly when it comes to inflation and interest rates. And this was the reason why we had this reset in yields. And to us, that creates a good entry point, given that it's very likely that yields have peaked. Inflation has peaked. And as a result, we think we're in the vicinity of a yield peak as well. The risk reward means that you're getting a positive real yield on a long-term basis. And at the same time, you have upside potential if we, as we expect, head towards recession.
Yeah, but that's still a big call, isn't it, Hani? I mean, just to pick up on Steve's line of questioning, if you looked at fixed income last year, there weren't really many safe places to hide. Emerging government debt, negative 8.7% in local currency. Global developed sovereign bond index down 12.5%. It's asking a lot, isn't it, at this stage, to believe that the central banks go from hiking rates to not hiking rates through the course of the year and even cutting them.
It's a good point, Jeff. I have to tell you that for years, we have stayed away from those bonds, fearing that the value is really not there and you're very vulnerable to precisely this kind of environment. But this reset that we've had does change the picture. Now, we're not being contrarian for the sake of being contrarian, but in fact, we find that it is a setup where one is better placed taking advantage of this rise in yields. Now, in terms of what does it take to actually realize value, that's what I would say that the risk reward is quite attractive. Even if we don't have cuts in interest rates this year, we don't really expect them. We think that your downside risk from owning bonds at these levels is quite limited. And then the upside is quite good if we do end up in that negative growth scenario. So that's what I mean by a good risk reward, better than we've seen for a decade.